Hello, everyone. Today we're going to be talking about the Dow theory and the six principles of the Dow theory. The Dow is an approach to trading. It was developed by Charles Dow back in the day. Now, the first principle we need to talk about is the market discounts everything. What does that mean? Dow believe that all the information is already baked into the market. No matter what, it's like the stock rating or the stock performance, no matter what, all the information that we need is already in the chart. So there will be no surprises. Now, does that still stand today? Who knows? But a lot of the time you do see that. You do see that's happening. The second principle is the market has three types of trend: the primary, secondary, and minor trend. Let's talk about the primary trend. The primary trend is the big yearly trend. Is basically the big movement of the trend. The secondary trend is the monthly trend. It could go in sync with the primary trend or against it. And the minor trend is basically the weekly trend. Uh, Now we gotta understand this. As a day-to-day trader, a lot of people like us try to look at charts like on a basis like on a smaller scales. So we can consider like the primary, secondary, minor as an example in our scales. The primary could be a weekly chart, and the secondary could be a daily chart, and the minor could be like an hourly or a 4 hour chart. Uh, but the main thing to remember here is when they're not going, most of these trends go in sync, but when they don't go in sync, that creates investing opportunities for us to buy in or sell. And you do gotta remember that the primary trend is the most weighted trend of all. It's the trend that's gonna win at the end. It's gonna take everything with it. The third principle says the market trends have three phases: accumulation, participation, and distribution. Now, what did that mean? So, Dow believe that each trend, sorry, has three phases. Accumulation phase is when all the smart investors start to buy in a stock because they see the value of that stock, even though the market hasn't even moved up yet. The participation phase is basically when everybody goes public, everybody starts to understand the value of the stock, and everybody starts to pile in. The stock starts gaining momentum, and it's going really fast in an uptrend. And the distribution phase is basically when the less knowledgeable, less experienced investor try to buy in. But that's at that time, all the people, the smart investors that actually bought in the accumulation phase, are already selling their stocks and they're already cashing in their profits. The fourth point we want to talk about: the averages must confirm each other. Now, we're not talking here about the moving averages. No, we're talking about the Dow Jones average, industrial average, and the transport index. You got to remember, when this theory was applied, it was applied back in the 1950s when all the trading was done by railroads and etc. But nowadays, everything is digital. So, does that still apply today? Well, technically, no, but we do gotta say that that's what Dow Jones actually believed in. So what he thought is that when one of the indexes, that basically either the Dow Jones Industrial Average or the Transport Index, is reaching a new high, the second one must reach a new high. They don't have to go in sync, but they must move together. The fifth point is volume must confirm the trend. So Dow believe that the volume is a secondary indicator to the market, as most of us do actually believe that. So when you have a strong uptrend, you expect to see volume increasing with that, and where more people start to buy in, the trend start picking up momentum. As you can all notice that the volume starts to increase more and more, and when the trend starts to dies out, the volume starts to drop a little bit by a little bit. So that's basically what he meant about volume must confirm the trend, because you don't want a trend where it's like a strong uptrend with low volume. He considered that to be a weak trend. The sixth point and the last point that we're going to talk about: a trend will continue until an opposite force is applied. Now, what does that mean? He believed that for a trend to continue, it doesn't need. Let's take an example: an uptrend. So that's a bullish market. So it doesn't need more bullish news for it to keep going. I mean, more bullish news will help with the momentum of the trend, but it's not necessary for the trend to continue. As soon as we have some bearish news, which is the force that is applied to that trend, that's where the trend start to reverse. Thank you all for watching. Please like and follow for more content. I'm going to be posting in detail and in written form underneath this post about all the principles of the Dow theory. Thank you all for watching and have a great day.